And Derek, you're starting us out, so.
Yes, sir. So thank you everybody for joining us today. Just going to go over a little bit of continuing education ground rules to start us off. That way everybody kind of knows what we're going by here. So since this is for Texas Department of Insurance continuing education, in order to get education, you do have to be present for pretty much the whole event. We do give everybody a couple of minutes here at the beginning to get in, and then once we get into the kind of Q&A session at the end, we will have hit our kind of 50-minute limit. So if you've got to run at that point, we totally understand. But we do track how long you've been in. That's part of Zoom. It tells us how long you've been in here. So I always hate to have to tell people that you only attended for 35 minutes. Can't give you credit. Sorry. So please do stay on. We will also have a question here in, I don't know, 5 or 10 minutes into the presentation. That is to also kind of track participation. So there will be an answer that you can type into the chat. It'll be a multiple choice. We just need you to answer in some format. Don't have to answer correctly. And then finally, at the end, we always kind of ask for any feedback, which provides us, again, through the chat, another opportunity to see that everybody's still attentive, because we got to prove the TDI that you were here and actually on it and not just turned on a computer and walked away. So that's the game plan and the rules. And by all means, anybody has questions throughout, please do put them in the chat. We will address the questions as they go. It doesn't have to wait till the end. We want this to be as back and forth and real time as we can, as conversational as possible. So Andra, it's all yours.
Okay, let's go to the next slide. There we go. And this presentation was originally created last May because an unusual occurrence happened. The pandemic came, people were losing jobs, and I hate to say it, you don't want to all of a sudden be successful when other people are hurting, but the life and disability insurance, certain markets were succeeding and they were growing. And it became a buyer's market in addition. And certain things changed very rapidly, and some carriers, not all, adapted quickly. A lot of this was technology driven, as we'll talk about it. And so we're going to get into a lot of insurtech and fintech discussion, a lot of the new underwriting tools, and some explanation of those, so that as you're talking to your clients, they have an understanding of what's going on with online and digital usage. So let's go on to the next slide. A little bit about us. I think the advertising for this listed me as the secretary treasurer for NAIFA-Texas. Well, surprise, I ran unopposed and I won the election. I am president-elect for 2021, and Mr. Rodney Mogan is on the call, and he is the secretary treasurer for 2021. So congratulations, Rodney. But for the most part, our expertise is in disability insurance, but we do handle life insurance, and we've been in the brokerage world myself for over 35 years as an agency. We'll hit 25 years come April 1st of this year. So, and our motto has been making insurance easier. The way we do that is we know how the processes work, and then we simplify it in explaining it to the producers and the client so that the business gets issued. So let's roll on to the next slide. So what are these slides going to go through? Well, the world changed. You all know that. Your clients still need life and disability insurance. To make this CE, we do have to do a little bit of life insurance 101. We do have to do a little bit of DI, disability insurance 101. Then we're going to go through those evolutions and what are the ways to obtain coverage today. So let's roll from there. Next slide, please. What's different? Social distancing, being able to see clients face to face, or clients not wanting to see anybody, be it an agent, be it an examiner, the employment, unemployment swings, the gig economy, remote work. These things are dramatically changing the underwriting environment and what's going on in the workplace. Loss of benefits is becoming a huge factor for people with unemployment, with employers also revenue streams changing. How they look at benefits is changing. What they're paying for is changing. There was a survey I recently saw that was published in NAHU's monthly magazine that since 2009, short-term disability has decreased as a voluntary benefit 40%, long-term disability 30%, and life insurance 20%. That's a lot of coverage that's gone away for people. And I'm not sure that it's been made up for in individual sales, that they've bought it on their own when the employer wasn't offering it at the work site anymore. A lot of uncertainty, where to get answers. And as we know, the internet answer isn't always the right answer. Online answers, confusing, contradictory. Let's face it, Dave Ramsey and Susie Orman are in the business of selling books and their programs, not necessarily selling product or giving the best advice in all cases. They first want to get their name out there. And in some cases, for some folks, saying the most controversial thing gets them the biggest headline or the most talked about, not necessarily the best thing. So we'll move on. So what's the same? We know everybody still needs protection. We know that there's a huge population without coverage or underinsured. There was a survey done, and I'm either going to get it wrong. It was either the Harvard or MetLife had surveyed 6,000 employees, which was a credible sample, and asked how many of them had disability insurance through their workplace. And about 2/3 came back saying they had coverage. When they polled the employers of that 6,000 group, only 1/3 offered disability insurance to their employees. That's a huge gap in what people had to what they thought they had. So, workers' comp is not long-term disability insurance. Social Security is not being covered. Personal coverage, and then having, group LTD, will it pay the benefits? So the reliance on the benefits and what happens when these people are unemployed or change jobs. What happens when they're downsized, part-time, gig economy, or they retire. Life insurance, that is not often portable. And legacy, there's very little estate planning occurring, where people are talking to their kids about, what if? And a lot of that what if happened a lot sooner than people expected in the face of a pandemic. And that's sad, but it's true. So we'll move on to the next. And I'm just checking the chat quickly, make sure there was no questions there that we missed. So pros and what changed: automated underwriting. This happened very, very quickly. A lot of carriers had plans for predictive underwriting, had plans for automated underwriting, but their plans were to phase it in over the next 2-3 years. I was in conversation with one carrier that we were going to look at an experiment for predictive underwriting on a single large case in June of this last year, when we were looking at enrolling 600 lives on a voluntary basis and possibly using an automated underwriting process. That program went in effect very quickly. And Enrico is raising his hand, so I think he needs to be unmuted. So 2 people have raised hands. So I think we need to unmute the lines there, either Beth or Derek.
Yeah, we've unmuted. I think Enrique and Charles are still muted on their end, but they've been allowed to talk if they had a question.
Okay, Enrique, why don't you go ahead?
Yeah. Enrique, you just need to unmute on your end. And same with Charlie.
He just let us know. I think Charles is,
yeah,
if you want to go ahead.
I just raising my hand.
You didn't raise your hand, Charlie?
I just did.
Okay. You had a question?
No, I really didn't have a question. I just wanted you to know I was here.
Yay. Well, I'm glad you're here. And Enrique, are you with us? And did you have a question?
No, I think he had the same thing. So we're good. You can go ahead.
Oh, right. So what happened was the carriers had to take these systems that they were starting to experiment with, and they fast tracked them. Some of them didn't get them out very quickly. Some of them got them out very, very quickly. Some of them had problems with those. Some of them came out with amazing speed and amazing results. And their sales went up tremendous this last year. With that, 100% online process meant in some cases, people didn't need to speak with an agent. And we've seen a proliferation of, one company, here in Dallas, Bestow, come up with an online get your term insurance without ever talking to an agent. With many of these, they do not require any fluids or medical exams. It can be all done online or phone interview. With that, the con is they're not speaking with a representative to get a quote or coverage. So their questions aren't being asked. When you buy online, what people don't realize is there's kind of this myth out there that if I buy online, it's cheaper. But people forget or don't know insurance is a regulated product. It still has a commission in it. They can't rebate that commission. They can't reduce the product online for it being sold online. So whoever put that website up is still getting that full agent commission. The price is still the same. When you buy through those systems, if you do have a health problem, a medical exam can still be required. It comes up, or if you are less than good health or excellent health, it can become almost a bait and switch where you see a super preferred rate and end up with a standard rate, which is much higher than a standard rate with another carrier. Had an agent been able to talk to you about your health conditions and place you with the right carrier at the start. So the problem with some of these systems have become that people don't always know what they don't know. Or if, in the case of some agents, if you're not licensed with a carrier, you can't get to the online application and it's not available. And because it's a proprietary system through that one carrier. So there ended up being a lot of gotchas here, there. Some people got upset. Some places, like I said, this worked like a charm. Some places, and some of the people we've talked to, these systems were an absolute nightmare for some people. I think we're working on one case since maybe it was April that he was declined for coverage. And we may get an offer now sometime this month for a client who originally applied online and was declined, and having to get all the medical records and get things done the right way. So this last year has been an interesting learning curve in the world changing. So let's go on to the next slide. Now we get our quiz. So Derek, why don't you explain this one again?
Sure, I can definitely do that. One thing I will just add real quick on just going back to this last slide for everybody is, you know, to Andra's earlier point, this is what the internet is telling all of our clients. This is from, and we put all the links at the bottom of the pages where we're going to give, you know, references so that you can go out and see it for yourself. But, you know, this is from Investopedia, which is a very, you know, popular site among consumers. And this is what they're being told about applying for disability and or life insurance from the different carriers, is these are all real pros and cons about specific offerings. And you can see over and over again in the life, this is for disability, the life is even more egregious. Over and over again, they're being told it's not good for them to work with you. You are the problem. Get you out of the process. That's a con. You are a con. You are a con, et cetera, et cetera. And that's what is out there. That's what we're all, you know, battling against in the new world. So as far as the quiz, okay, so this is, you know, first test of tracking everybody's attendance here. So please do in the chat function, you can send it to all panelists or all panelists and attendees if you want everybody to see your answer. But please do type in an answer now, either A, B, C, or D. Type that into the chat and send it along to us, please. We need to see everybody put that in. That kind of helps us track that you are here and attentive. So I see those flowing in. That's awesome. There's no extra credit points here. We just need you to give an answer. And we'll flip to the answer here in just a sec. And as a reminder, I did see a couple people hopped on a little bit late. I think so far it looks like everybody got in probably within the time frame that we'll be able to give you credit. But please do keep in mind again that we do track how long everybody's been in attendance. And we got to be able to have a minimum time limit to give you the TDICE credit. All right, so Andra, back to you.
Okay. And there we go. It depends. All the answers are factually correct. Some companies, millions, some 300,000, but the reason that you can get an unlimited amount is you can buy policies from multiple carriers. They don't say, oh, you got $1 million over at Ohio National, Emeritus, Penn Mutual, John Hancock. You can't get a policy here because you already got your non-medical. No, you can get policies as long as it hits the financial underwriting rules of that company. You can stack as many life insurance policies with as many carriers as you want underneath those rules. So there is no limit. Let's move on. Next slide. So many of the life and DI carriers, technology enhancements. There was a global survey. Outdated tech was the #1 threat to insurers, that the legacy systems were the huge problems. And you've heard about this a little bit, where some carriers had not paid death benefits on people 150 years old because they weren't able to bring up to date legacy systems of policies written on previous underwriting systems to newer systems. And with all these different proprietary systems, the life and disability insurance business has been at a disadvantage. And that's a little bit why we've been a little bit subject to what some people have called disruption, where some of these new tech startups are looking at getting these online, buy term easy fintech startups and getting huge amounts of venture capital to come after our business, because they think we are out of date and we're not providing the consumer the service and the ability, the products and things that they deserve. So let's go to the next slide. So what's changing here? E-apply, e-delivery, fluidless, accelerated, automated. These should all almost be household words now with this group. Lab picks, EHR, electronic health records, true risk life, may be not as familiar to some in the group, but will become more and more, and you need to be aware of, particularly true risk life, because the way automated underwriting works, when they don't take labs, those of us who are gray hair and older on the call will recall a day when we didn't do blood tests until policies were quite large. And that was changed, and I could ask, does anybody remember the reason, and toss all the millennials off the call. And the reason for that was HIV and AIDS. And HIV and AIDS has ceased to be a huge underwriting issue for quite a while, but we're still lab testing at fairly low benefit amounts. And why is that? Because those lab tests also gave us liver function, cholesterol, glucose results, and a lot of other information that made determining risk a lot easier for the underwriter, and particularly not issuing too cheap a policy to somebody who was a bad risk. So TRL, True Risk Life, is basically based on credit scores. And as the blood test didn't go away as the HIV/AIDS crisis ended, does anybody on this call believe that the credit score will go back in Pandora's box when the pandemic ceases with a vaccine this year? And most of you are still muted, but I'm going to believe that most of you don't think so. And thank you, Rodney, for chiming in with a big no there. No, it's going to be a huge. And Charlie, if that's a raise a hand for you agree with me, thank you. If you have a question, I think you're still unmuted, so go ahead. No. Okay. Let's go on to the next slide. To kind of, describe what I was talking about, that disruption and fintech, I've taught a class on Tech Savvy Advisor, and I showed a lot of people this slide from Nerd's Eye View, Michael Kitches. His domain name is down at the bottom right-hand corner. You may or may not have seen this before, but this is basically a list of all of the fintech available to the advisor RIA space primarily out there. And all of those that are highlighted are ones that are new in the last year. That's a lot of new software and tech that's entering the market. That's a crowded space, and that's making, I don't know if it's making our world easier or more complex, but it's a lot of stuff. And that is available. These slides will be available. You can email Derek or myself, or put in the chat, and we will send that along to you. Let's go on to the next slide. So, people need these products. You need life insurance. Do you work for yourself, starting a family, paying off debt? It's probably smart to consider it. Anyone working in a high-risk job, extreme hobbies, you need life insurance. I was once asked, how long should somebody have life insurance? And I explained, well, if you're doing it for a buy-sell or for a loan, there's a certain term there, and that ends at a certain time. Term insurance will work. If you're buying it for your spouse and your kids, you're buying it for love, and tell me what the term limit on that is and when that ends, and I'll tell you when it should end. I got a chuckle, and they bought permanent life insurance. Sometimes a little humor works in this business. Let's go to the next slide. So why disability insurance? Because a claim that goes 3 months is likely to last 2.5, a little more than 2.5 years on average. That's a long time. And with Social Security, you know, not paying and you credit cards won't work and you can't borrow, you can't, you know, some of us can't go back and live with our parents, or our kids can't help us because we're still helping them. You need that safety net. So we'll go on to the next slide. For those of you who are not familiar with disabilitycanhappen.org, these are all real life stories that you can pull up the videos on. The top left one, Michael Sizemore, is a young man I have met. Particularly good video. He was actually hit by a drunk driver while crossing the street after watching a football game. And lifehappens.org can also get these, as Derek's putting that out. Things happen, and these are all videos you can show your clients. If you've never gone on those sites to use the third-party collateral that's there, this is not any company's name on it. I highly recommend you take a few moments, go out to those sites, take a look at it. If you want a tear-jerk moment, we didn't put it on here, but there is one about story time, where a dad's reading a story to its child. I won't go into the why it's a tearjerker, but pull that one up someday. That one will get you. Let's go on to the next slide. So the one-on-one portion, you know, life insurance, one of the things that I've always had a small issue with my friends who are heavy in the sales of life insurance is it's always, do you want term or do you want permanent? Do you want term or do you want permanent? Hey guys, you can have both. It's fine. You can sell both of them. That's all right, you know. And the idea that, you know, UL is both, you know, if the person wants a permanent policy, UL, whole life, one of the, you know, index, whole, whichever, and a separate term policy, more than one policy is fine out there. The whole, you know, concept that, oh, they're overpaying in the policy fees is not that big a deal. And I find when people, you know, are told that, you know, a combination of these things and conversion and those items, they get a much more better feel for people that, you know, oh, you're being honest with me, and yeah, I can have a choice of all these things. It's not one or the other. It's I can have whatever I want or all that I want. And we'll go on to the next slide. You know, life insurance, temporary needs, loans, business, buy, sell. I mentioned about love, family, legacy. Charitable giving is coming back on the radar a little bit more recently. As the tax laws changed, I've seen more people doing more creative things with charitable giving, particularly with the 20,000 plus unified deduction that may be doing a larger gift every 5 years through some type of charitable gift with life insurance is a better tool. So there's some very creative planning going on with those things. But right now, less than 50% of households own a personal policy. There's way too much reliance on group life. And the problem is when you hit 65, 67, and people even retiring at 70, and they lose that coverage, and then they start saying, well, I want to get a policy, and then they're shocked at the cost of having waited all those years to buy their first personal policy. And it's like, why is it so expensive? Well, you didn't pay in for 40 years. If you had bought, even a small whole life policy for burial 40 years ago, it'd be paid off by now. And so talk to people about these things so that they're not caught completely off guard. Next slide. The other thing is, life insurance is not just about the death benefit. We're seeing a lot more long-term care sales because of the critical illness benefit, the long-term care portion. And for those of you following the news, the new tax law change, or the change, whole life insurance is going to get a lot more attractive with the change in some of the TEFRA-DEFRA corridor rules. Life insurance as an asset class will be a lot more, as an investment, will be a lot more talked about in the next few months. Also in special needs cases, we're seeing a lot of more use of survivor life insurance between a parent and a child, with the uninsurable being the child. A very creative and unique use of survivor insurance. Next slide. Living benefits. Seeing a lot more people liking the choice as long-term care insurance has gotten very expensive. Prices have gone up. Policies have been canceled. With the long-term care riders, the living benefits, or the hybrid policies, that more and more people are looking at those type benefits. And if they don't need them, they still have the life insurance policy, the cash value for their beneficiary. So instead of a use and lose, it's a use, or I still have something for my legacy. Next slide. And disability insurance. Well, truth is, everybody does have Social Security, or almost everybody. Certain railroad workers and clergy members do not, but the vast majority of people do have Social Security disability. Here's the problem. Social Security doesn't always pay, and the waiting period is 6 months. First check sometimes takes up to a year if you're approved the first time around. And on appeal, it may be 1.5 to 2 years before you get approved. In the employer market, only 30% of employers offer STD or LTD. And this stuff is really important. Take it from somebody who really knows. For those of you who know me, my spouse is totally disabled, and I've been dealing with some health issues for a few months. So this stuff is very, very important. So don't take your health for granted. And particularly, through a pandemic, we have seen a lot of people, and it always surprised me, the first ones who are buying a lot more coverage Doctors, what is it they seem to know that the rest of us don't? Because they are buying, and about 85, 90% of all doctors have personal individual coverage. Out of the other occupations, the participation rate is far, far less. Let's go to the next slide. So, and if you're insured, you're likely underinsured. Why is that? Because there's 700 life insurance carriers and only 32 that are currently manufacturing individual disability in the US. And as I have mentioned, even to some clients, what is the difference between life and disability insurance? Whether or not you get to watch the show, the family still suffers through the loss of income and added expenses. You know, I actually told that to one particular attorney and had told him that if he was a miserable SOB, that if he died, that wouldn't be a problem. But if the heart attack didn't kill him, he was going to need a very big bucket of money to pay for people to take care of him. And he did sign the application and a check right there on the spot. I don't recommend that as a closing technique for all situations, but in that case, it was very effective. Okay, and I will say this is the part where I really hate Zoom because I don't know if any of you are chuckling about that or smiling, but we'll keep moving on in a Zoom world. Next slide. So people are wondering, what if? Okay, thank you. Got it, guys. I guess you can't do emojis and smiling faces. People are wondering, COVID-19 claims, you know, what happened this last year, you know, should I have been better prepared? Should I be better prepared for the next time? You know, we're seeing a rebound with a mutated virus. Will the vaccine help with this next one? Quoting and sales are up. Our agency sales were up tremendously this last year. And as I mentioned, the physician market, healthcare market, has been up tremendously. Why? Because they do see the risk as real, particularly disability insurance, and yes, life insurance as well. Let's move on to the next slide. So I mentioned about e-apply and e-delivery. These systems, you know, electronic signatures, DocuSign, straight through processing, have become fairly regular. Most people are familiar with these, I think, by now. Most carriers have adopted this. Some of them have gotten very easy with DocuSign. I get a question every now and then, why can't I just get somebody to sign it in Adobe? Well, Adobe Sign, yes, because there's a certificate, there's a location. We know that the person signed it. DocuSign, we know the person logged in and signed it. We know where they were when they signed it. There's a certificate with it. Why can't we just get an electronic signature, i.e. somebody signing on an iPad with their finger? Because we don't know who signed that. There's no proof of where, when, how, if that was the individual. No witness. So that electronic signature doesn't fly. And that's why some companies were really slow adopting this at the beginning. They just weren't comfortable with the technology at the start. And some have gone to, you know, the straight through processing. It has to be their proprietary system, whether that's iPipeline, Firelight, or their own created system with some companies. Fluidless versus accelerated versus automated underwriting. You're going to see more and more of a reliance on this LexisNexis Risk Solutions True Risk Life, where getting an exam is going to be less and less, and they're going to rely on that credit check a little bit more. But here's where it gets a little bit interesting. When people say, oh, well, you don't have to have an exam, be careful on that one, because random holdouts do happen. They can turn around and say, nope, this one is still subject to an exam. We want an exam on this person. We want a paramed to see this person. We want a height and weight. What's driving those things? Sometimes it's MIB. Sometimes it's script check. Sometimes it's Google. Sometimes it's Facebook. Sometimes it's the person, the underwriter sees a picture of this person and says, height and weight? No, I'm not buying that one. I'm not sure I saw that chat there, Rodney. Let me pull that back up.
I think he's asking about, where does he see, or where do we see kind of the automated algorithm type underwriting going?
Well, is it on this slide or the next slide, Derek?
Next slide.
Next slide. Let's go to the next slide of where is this going? Because this is different. Greater use of business intelligence, analytics, big data, photo evidence. There are now software and analytics that can tell evidence of illnesses from a picture. There's a company now that is selling a voice analysis software that can determine if somebody is a tobacco user based on the voice analysis. This is a $10 billion industry problem of people non-disclosing tobacco use. You think these folks have a product that's going to be bought? Oh yeah, it's going to be bought and it's going to be used. And those phone calls are going to be run through that software, and it's going to tell. They won't have to ask, are you a smoker? It'll turn up in the analytics. So these analytics are going to start turning up things that you never knew. And, I've had some funny things happen. I had a commercial grocer. It was organic farming. His website had him in overalls and a pitchfork, and it was great marketing. This guy had never been on a farm in his life. We had to fight like hell to get him back to a 6A from an A-class farmer because of the marketing. And they thought that he actually went out in the fields because of the pictures. But there's other things that exist on Google. You go out, you can find evidence of court cases. You can evidence evidence of other problems that exist. Facebook, people put things about their partying, and there's other social media that, Instagram, Waze, whatever, some of these other ones that us baby boomers aren't as familiar with, that be careful that the history doesn't catch up with the client, of the time they were maybe using some substances they didn't want to come up later in life on an underwriting. If you say you never used it, some questions are the last 10 years. Some questions are, have you ever? So let's not prove ourselves a liar, because these things can all be searched very quickly. Predictive underwriting can get into not only the quality of the client, but the quality of the business submitted by the agent, the agency. So if an agency like mine that places 93% of its business might get a certain score, where another agent who is maybe placing or has a high or low persistency may not get the benefit of the doubt on a jump ball. So Travis has a question there. We got a raised hand. So,
Travis, if you want to unmute yourself, you can.
hello, Travis.
Yeah, you have the ability to unmute yourself if you would like to speak.
Okay, if not,
Just jump in whenever, Travis.
I'll roll on. And the pandemic really has sped up the use of these, and somebody else has now just raised their hands. So who else do we have with a question there? Rodney, do you have a question?
Yeah, I do. So really, just as a follow-up to the question I wrote on chat, Andra, and this has been very helpful, is, like what you were saying, is different companies have different, fluid lists and things like that, and all those different things for both DI and life insurance. And, they've got it right now in very specific age ranges and stuff like that. Do you see with what you were just the utilizing social media and stuff like that, which I didn't know about. I think that's actually amazing and scary at the same time. But do you think that they'll expand that to maybe age 60, age 70? Right now, generally, I'm seeing most companies up to age 50 or whatever. Do you think that they will, make it larger numbers, things like that, larger benefit amounts? That's the type of expansion I was also talking about under the algorithm.
Yeah. Oh, definitely. Some of them already have, one Cincinnati-based company has already started increasing almost back to a normal type age limits again. And they had a reputation for doing more of a substandard underwriting, and I'm not talking Ohio National or Emeritus. And I try and be carrier agnostic on CE, folks. So you're going to see a number of the, some of the normalization of these benefits and things coming about. The use of Googling that actually has been going on for 5 or 6 years that I've known about. So that's not a new thing. I've known some DI underwriters that have done that for quite a while. And I'm seeing more and more life insurance underwriters doing it now. So how are we doing on time? 6 more minutes. And oh yeah, we're right at the end. So we're in a good place here for questions and answers.
And Andra, I do see one question that's already kind of popped in here that actually goes along a little bit with what Rodney just asked, and I'll just relay the question and then go ahead and answer it. So the question was, you know, kind of fluidless versus accelerated versus automated, you know, who's doing what. And really what it boils down to is and Rodney hit on this a little bit, it is carrier by carrier. It is disability versus life. But the overarching view is that, you know, fluidless really just means no labs, no blood and urine. You may still get medical records. You may still have to do, maybe even have to do a paramed. You may actually still have to meet with somebody to answer questions or do a phone interview to answer health questions. You're just avoiding the fluids. Accelerated, which often gets confused for fluidless, is a step farther where you're expediting the turnaround time. You are submitting it probably online. It's being done in a matter of a day or two. They are not going to get medical records. That's a little harder to qualify for. You've got to be in those age ranges that they're willing to accept you, the health that they're willing to accept you, and not going for too much coverage with just them. But as Andra alluded to earlier, you can always, and what people don't realize, you can go get up to 3 million from one carrier, but then 2 million from another and 1 million from another. I mean, you could go get $10 million on accelerated underwriting, assuming you are of the correct age, which typically under 60 or under, and you are of at least a standard non-tobacco health or better. DI is not really in the accelerated underwriting world as much. There are some new fintech coming out that's more in the accelerated, but DI is still really in just the fluidless. They'll let you avoid the labs, but the accelerated portion is really more on the life insurance. And then automated is what is brand new in the life insurance world, where that is the apply online, the bestow, you know, apply online in minutes, get your decision in minutes. The thing people don't realize, though, as Andra alluded to earlier, is automated underwriting can cause very large problems for people, not realizing that then when you go to do an accelerated underwriting application because you got declined for automated because they didn't like a prescription you were on, may have just been a middle nervous prescription, but they didn't like it. You can't probably now get accelerated underwriting because you can't answer the question positively that you have not been rated, modified, or declined, which is a question even on most accelerated underwriting apps. So people go out, they try to do automated, they get kicked out by one of these new fintech companies, and lo and behold, now they can't even do the sped up expedited process that, you know, a broker or producer or agent kind of helped them through. And they're back to, they got to do the full blown thing and do the exam, and they shot themselves in the foot if they can even get coverage. You know, so that was a question that piped through earlier and kind of went along with, you know, where is this going? As all of these carriers are only expanding this more and more and more. The levels are going to go up. The amounts are going to go up. Some of them have already formalized and permanently made these levels that they built for the pandemic. You know, these are now permanent changes, and they can't go backwards. You can't put the genie back in the bottle.
And let's, you know, True Risk Life and LexisNexis, you know, these credit things, these are double-edged swords. You know, you think, you know, okay, medical resident, this person's, you know, a doctor, they're going to be making great money very soon, but this is a person with 200,000 of debt, maxed credit cards, and had they done labs, probably would be preferred plus as a 31, 32-year-old healthy young person. But with the credit issues right now, or not having credit, or a young person might only get a standard or a preferred offer, only dollars difference on a term app at 30, But to convert that policy in 20 years is going to be a significant price difference, converting a 50-year-old at preferred plus rates versus preferred or standard rates. So some of the people aren't realizing how much these different programs are going to affect them in 20 years. If that makes sense. So, any other questions? And I think we can unmute anyone, or if anyone wants to chime in. Or if not, I think we're at the end of the hour, and you can put in your comments, whether you liked me, hated me, wished you hadn't wasted the hour, or whatever. And, you know, my commercial for NAIFA-Texas, please attend all NAIFA-Texas events and please give to the PAC.
Yes, and then as you log out, you'll be seeing a pop-up evaluation as well. So thanks everybody for attending, and thank you Andra and Derek for this webinar. We appreciate everybody and hoping everybody's 2021 is getting started off well.
Thank you, Beth.
Thank you.